Welcome to Investing Lighthouse, where we explore the world of investing. Today, we're going to ride the waves of interest rate hikes and see if the Federal Reserve's recent moves have pushed the U.S. economy towards a gnarly wipeout called a recession. We'll compare the current situation to similar moments in history and discuss the impact on unemployment, wage growth, and market returns. So grab your surfboards and let's paddle into the deep end of monetary policy. From March 2022 to May 2023, the Federal Reserve made bold moves, aggressively raising interest rates like a surfer riding the tallest wave of the day. But the question remains, why did they take such action? But why did they do this? To keep inflation in check and maintain economic stability. However, there's a risk that these rapid rate hikes could send the economy spiraling into a recession. Let's take a moment to examine the current interest rate scenario and put things into perspective. As of May 2023, the federal funds rate, which refers to the interest rate banks charge each other for overnight loans, has climbed just above the 5% mark. Though this rate is significantly higher than the near-zero levels witnessed during the pandemic, it still pales in comparison to historical highs like the 20% peak observed in the early 1980s. Now, let's look back at some historical examples of rapid rate hikes to see if we're heading for a wipeout or if we can still ride this wave to the shore. Going back in time, investors. And our first stop is the early 1980s, when then Fed Chairman Paul Volcker hiked rates to tame the double-digit inflation monster. In 1981, interest rates peaked at a whopping 20%, which sounds scarier than a shark in the lineup. The result? A sharp recession from 1981 to 1982. With unemployment hitting 10.8%, the highest level since the Great Depression. The stock market also took a hit, with the S&P 500 experiencing a drop of around 27% from 1980 to 1982. Next up, we have the late 1990s, when the Fed under Chairman Alan Greenspan raised rates to cool down the economy and deflate the dot-com bubble. Between June 1999 and May 2000, the federal funds rate increased from 4.75% to 6.50%. The Nasdaq, home to many tech stocks, plunged over 75% from its peak in March 2000 to its bottom in October 2002. Finally, let's not forget the housing bubble in the mid-2000s. The Fed raised rates from 1% in June 2004 to 5.25% in June 2006. This tightening contributed to the burst of the housing bubble, leading to the Great Recession that lasted from 2007 to 2009. During this period, the S&P 500 dropped around 57%, and the unemployment rate soared to 10%. Alright, time travelers, we're back to the present. Let's see how the recent interest rate hikes stack up against these historical examples. As of May 2023, the unemployment rate stands at 3.4%, which is comparable to pre-pandemic levels, but still far from the devastating unemployment rates experienced during the past recessions. So far, the impact on the unemployment rate seems to be mixed. While some sectors have experienced layoffs, others are still hiring, making it hard to tell if we're in for a full-blown wipeout or just a little turbulence. When it comes to wage growth, things get tricky. Higher interest rates can slow down business investments and expansion, which could mean fewer job openings and slower wage growth. But on the flip side, if the rate hikes successfully tame inflation, then workers might see their purchasing power increase. Now let's check out the impact on our favorite playground, the stock market. Just like the historical examples we discussed, the stock market has been riding some wild waves, due to the Fed's aggressive rate hikes. The S&P 500 and Nasdaq have both experienced increased volatility, with some sectors feeling the pinch more than others. As of May 2023, the S&P 500 has posted a year-to-date return of around 7%, while the Nasdaq has achieved an impressive return of 16% at the time of this recording. These numbers might seem underwhelming compared to the stellar market performance during the pandemic recovery period. However, it's essential to remember that market returns can vary greatly from year to year, and it's the long-term trends that matter most. Typically, high-growth stocks like technology and innovative companies are more sensitive to interest rate changes. As rates rise, their future earnings become less valuable, causing stock prices to drop. On the other hand, some sectors like financials can benefit from higher interest rates as they earn more from lending activities. Banks, however, have their own set of challenges right now due to the yield curve inversion. An inverted yield curve means long-term interest rates are lower than short-term ones. Banks usually make money by borrowing short-term and lending long-term. When the curve inverts, this process becomes less profitable because the difference between what they pay when borrowing and what they earn from lending shrinks, making it harder for banks to make money. What's the bottom line for both seasoned professionals and beginner investors? It's important to maintain a well-diversified portfolio and remain vigilant for possible market shifts. Although it's nearly impossible to predict the precise outcome of the Federal Reserve's actions, staying prepared for various scenarios can help you navigate these choppy waters. The million-dollar question: are we on the brink of a recession? Or can we ride out this wave of interest rate hikes? The truth is, it's tough to say for sure. While there are some similarities between the current situation and past rate hikes that led to recessions, there are also some key differences. For one, the pace of the rate increases has been faster than in some previous episodes. But the overall level of interest rates is still relatively low compared to the sky-high rates of the 1980s. Additionally, the global economy is more interconnected than ever, meaning that the Fed's actions could have ripple effects beyond the US borders. Other factors to consider include current economic indicators, such as GDP growth, consumer spending, and business investments. While some indicators may exhibit signs of slowing down, others remain robust, creating an ambiguous depiction of the economy's overall health. Ultimately, investors need to be prepared for the possibility of a recession. But it's essential to remember that even in the face of economic downturns, the market tends to recover over time. To sum it up, investors, the Federal Reserve's swift interest rate hikes have created quite a stir in both the economy and the stock market. Though it's challenging to predict whether a recession is looming, it's crucial to stay updated, diversify your investments, and maintain a robust mindset amid uncertainty. Always keep in mind that the stock market is comparable to an ocean, at times tranquil, and at times turbulent. However, with the correct mindset and strategies, you can surf the waves to long-term prosperity. We're always open to hearing your thoughts, so don't be shy. Let us know what you think in the comment section below. If you found this video informative and useful, please show us some love by smashing that thumbs up button and subscribing to our channel. Thanks again for watching, and we look forward to seeing you in the next video.